With car prices getting increasingly higher over the years, and with the new average car price being over $47,000, it can be hard to tell how much car you could actually afford given your salary. Because some of these monthly payments for these new cars could be over $1,000 a month. So you definitely want to see and make a budget of how much car you can afford so you don't end up overspending. So in this video, I'm going to break down how much car you can actually afford based on your salary and go over some other useful tips, like if you should buy a car outright in cash versus leasing it, and even if you should be buying a new car versus a used car, and much more. So a well-talked about rule when looking for a car and deciding how much money you should spend on it is the 20-40-10 rule. The 20 means that you should be putting down a down payment of 20% or more on the car. The 4 means that you should only be financing a car for 4 years or less. And the 10 means that you should only be spending 10% of your gross income on car expenses. So let's break this down a little bit more, starting with the down payment. So here's a graph of how much money you're actually going to spend if you decide to put 20% down on a car. So for a $40,000 car, you can see that's going to be $8,000. $70,000 car would be $14,000. And then if you want to buy a $100,000 car, you're going to need $20,000 as a down payment. And why do you have to put 20% down on a car? Can't you just put $0 down? Well, there's a couple reasons why having a high down payment is good versus if you just don't put any money down at all. And a big reason is the higher the down payment that you put on a car, the less your monthly loan payment will be. Not only is this obviously going to have a lower monthly payment for your car, but it's also going to help you limit the amount of interest you are paying. Also, a higher down payment is more beneficial in the eyes of a lender because it shows that you're putting more money down, which means the lenders are more likely to give you a favorable loan. Now, there's other factors that go into getting loans for a car, such as your credit score. But if you have a really good credit score as well as a high enough down payment, you can qualify for very good loans. Another great benefit is that the higher the down payment you have, the less likely you are going to be underwater on a loan. Cars depreciate really quickly, so you might actually be owing more on the loan than what the car is actually worth. Now, I will talk about depreciation later on in the video, but having a high depreciation with a low down payment can basically assure you that you're going to be underwater on a loan. And just as an example, a car could be worth $10,000, but you're actually going to be paying a loan amount of a car that's actually valued at $12,000. So you're actually underwater on that car for $2,000. The next part of the rule is the 4, which is going to be you want a loan payment of 4 years or less. And by doing this, you're actually limiting the amount of interest you're going to pay on the loan. So by having a term that's 4 years or less, you'll be paying a lot less interest than if you had a 5 or 6 year loan term. Also, the longer term that your loan is for, the more car you could afford because the payments are going to be less. So by having a term that's 4 years or less, you can assure yourself that you're budgeting properly and getting a car that's actually going to be in your salary range. Because over the long run of paying month after month for that car payment, that interest is going to snowball and you'll be left with paying a lot more than you otherwise wouldn't have made if you just stuck with 4 years or less. The last part of the rule is that you should keep your total transportation costs less than 10% of your monthly income. And you want to do this to ensure that you're sticking with your budget and not overspending every month on a car. And the main things that you want to keep under 10% in this category is just going to be the monthly payment on your car and things like insurance for the car. So if you look at this chart, this is actually showing salary and how much of monthly payment falls in that 10% rule. So for instance, $40,000, you want to spend at max $333 on car payments. For $70,000, it would go up to $583 per month. And then if you're making $100,000, you can afford $833 a month on car payments. Now, even though I'm showing you these numbers that you realistically can afford given that salary range, that does not mean that you have to spend that max limit per month. You could always buy a car below your budget so you could save and invest for other things. Another thing that lots of people don't think about when buying a car is that you should budget for things like unexpected maintenance costs as well as gas. Now, different brands of cars can vary drastically on how much money you're going to spend per year on maintenance. So for a Honda, for example, a $400 per year budget for maintenance is probably pretty reasonable. But if you want to go up to a Mercedes, that maintenance budget might go over $900 per year. So it's important when you're searching for a brand of car to see how much that maintenance cost is. Because even if you buy a cheap Mercedes, you're still going to have to take that to a dealership and get it serviced, where it could be a lot more expensive down the line if you would have just bought a Honda, for example. Another thing to be mindful of is gas. You could be paying anywhere from $100 to a couple $100 per month just on gas. but again, that could vary a lot depending on what car you can drive. If you're looking at a diesel truck, for example, that car could fall into your budget, but you might be spending $300, $400 per month on gas, which might fall out of your budget at that point. But if you're looking at a hybrid car, you might be spending a lot less on gas. So it's important to factor in gas and maintenance when you're budgeting for a car. The next thing I want to go over is if it's better to buy a new car versus a used car. Now, generally speaking, used cars will be a lot more affordable than new cars. The average used car price is around $27,000 versus the average new car price is around $47,000. So this means that you're going to be paying less per month if you're going down the used car route versus the new car. Another great benefit of buying a used car is that you're going to avoid lots of that depreciation that you're going to get if you buy a new car. So the first year that you drive a new car, that car could actually depreciate 20% of its original value, and even after 5 years, that could go as high as 60%. But if you buy a used car that's maybe, let's say, 3 to 5 years old, you're going to actually avoid that big depreciation curve, and you're able to drive a car without it depreciating as much. And this is kind of what I talked about earlier on in the video, where you might actually get upside down on a car payment because that car depreciates so much. And that's really the case for if you buy a new car. So a con with a used car is that you're going to have more maintenance. Because it's older, it is more susceptible to wear and tear. So you might have to get it serviced more or take it to the dealership more often. You're also going to have to do your research and look at the car's history using sites like Carfax to make sure that what you're buying used is actually reliable and not full of some hidden problems. The last thing I want to go over is if you should be buying a car outright in cash versus financing it. So a couple benefits of buying a car outright in cash is that you're avoiding any interest payment and you can own the car outright with no debt. And you're also probably not going to overspend on a car because you're buying as a car that you can actually afford at this moment with the cash that you do have. But financing a car does have its pros as well, and it can actually be more beneficial than buying a car outright in cash in the long run. And a big thing with financing is that you're actually only putting around 20% down as a down payment, and that other 80% could be used as your capital for things like investing and savings. Now, if you bought a car outright in cash, that 80% as well as that 20% down payment would all be tied into the car and only solely focused on that car and not earning more money if you were investing it. So it's important to weigh those pros and cons when looking at financing a car or just buying a car outright in cash. Another thing that financing does is it actually helps you build credit history. Because you're making monthly payments, you could be increasing your credit score, so it can help you down the line when looking at other bigger purchases such as a house. If you just bought a car out in cash, you're not making these big monthly payments, so it won't really affect your credit score as much as if you were going to finance. Hopefully you were able to learn something from this video that can help you when you're making your first car purchase or even your next one. If you like this video and want to see other personal finance related topics, consider subscribing. I make a lot more personal finance videos that I think you might enjoy. Thank you very much for watching, and I will see you in the next video. Bye.